The Property Pod. Welcome to the Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hi there, Happy New Year and all the best for 2024 to all our Moneyweb listeners and readers. Welcome to the first Property Pod for the new year. My name is Suren Naidu, and on this show, we gain insider insights from leading executives, analysts, developers and entrepreneurs in South Africa's property industry. The real estate investment trust or listed property sector has had a tough few years, but ended off 2023 on a high of sorts with a stronger showing in the latter 2 months of the year. You guessed it, we are talking REIT sector performance for 2023 and the outlook for 2024 in our very first podcast of the year. We've got a heavyweight listed property guest on the show in Mohammed Kala, Executive Director and Portfolio Manager at Sisfikile Capital, to talk to us through the SA REIT sector's performance for last year. He will also share his insights on the year ahead. Mohammed is on the line. Welcome to the Property Pod, Mohammed.
Hi, Suren. Thank you. And Happy New Year to you and to your readers and listeners.
Thanks. Appreciate it. I usually do a podcast in this part of the year about REIT performance with the new year. And Mohammed, a LinkedIn post by you just last week caught my interest because it was about just that. In that post, you stated, and I quote, "An unstoppable rally over the last 2 months pushed SA's listed property returns into double digits, with the LP topping the leaderboard as the best performing asset class for SA in 2023. That's quite a turnaround considering it was in negative territory for pretty much most of last year."
Yes, indeed. It was quite a notable turnaround. The sector was actually down 7.6% for the year up until the end of October. It was, welcome relief for the sector. It is, however, worth noting that this rally that we saw in the last 2 months of the year wasn't exclusive to SA listed property sector. I think most risk assets globally had a kind of strong finish to the year, particularly interest rate sensitive asset classes. But certainly the sort of 20% performance that we saw in the listed property sector was enough to push the property sector from being one of the worst performing asset classes to the top of the leaderboards amongst the different asset classes in South Africa for the year.
Both the LP, which is the All Property Index, and the SAPI, the SA Property Index, closed the year just over 10% up from a total return perspective, I believe. Did you expect that in the third quarter, and what contributed to this turnaround of sorts for the year overall?
Yeah, I think, if you had to ask us at the end of the third quarter, would we think listed property would come up tops for the year, it would have been quite difficult. I mean, we typically don't forecast quarterly, but we certainly didn't expect it. We knew what the catalyst was. We just weren't sure around the timing of that catalyst. And ultimately, it really came down to some CPI prints that came out kind of early to mid-November from the US, from some big economies in Europe, the UK, kind of confirming the view that the Fed on the different monetary policies committees have kind of broken the back of inflation. And I guess there was this kind of realization that, we are going to see interest rate cuts a little bit sooner than initially expected. And ultimately, this resulted in a rally for the property sector. We always expected this to happen. We always communicated to our clients that during this period when there's kind of this realization that we've seen the top of the interest rate cycle and we can look forward to cuts in that period of time, be it kind of 6 to 8 months. That's a period when REITs typically tend to outperform. And kind of they've done exactly what we've expected them to do.
Well, you've talked about interest rates. I was going to follow up that question to talk about just that, interest rates starting to decrease, or haven't started yet, but the expectation that it's will start decreasing this year. Obviously, RITs have highlighted, particularly over the last year, about the impact of interest rates on debt levels and that sort of thing. But is it also a case perhaps of investors seeing opportunities in RITs again now, with the sector having possibly bottomed out, or is it still to bottom out, as it were?
Yeah, I think we think it's bottomed out. There was a lot of bad news priced in to the numbers in 2023, both on a macro and micro level. So, we started off 2023 with the onslaught of load shedding, and kind of the news just got progressively worse as we went through the year. It's fair to say a lot of that bad news on a micro level has been priced into expectations. As we look towards lower interest rates, that has a dual impact on property counters. So, lower inflation equals lower interest rates, lower bond yields, which is supportive for capital returns in the property sector, just simply because of the opportunity cost of investment. And then secondly, these property companies, as you mentioned, they've got gearing. On average, the sector's got about 37% loan to value ratio. And as we see interest rates ease off, that'll be supportive for income and distribution growth over the next 2 to 3 years. That takes a little bit of time to play out, as a lot of property companies have kind of hedges in place for their debt. But certainly that will be supportive. So to answer your question, I think the sector has bottomed out. It's always very difficult to kind of call the performance of the sector in a straight line, given the different macroeconomic challenges, especially in South Africa going into an election year. It's there's a little bit of uncertainty around that. But if you just had to focus on the numbers, it would tell you that the sector still appears attractive, and there's some positive catalysts for growth over the next 12 to 18 months.
Which sectors are top performers, and perhaps the top performing funds in 2023 from a SA REIT side? So,
if we had to look back to 2023, there were some clear standouts in terms of share price performance. It really was the offshore stocks in the All Property Index. So the likes of Shaftesbury Capital, MLI before it was taken out, Hammerson, all up kind of 40 to 50%. So quite big numbers in 2023. Remember, the UK stocks were beaten quite hard in the latter part of 2022, post the Liz Truss mini budget. So they came into 2023 looking quite attractive. And we saw those stocks kind of outperform. A little bit of rand weakness as well added to that outperformance. So there was some clear standouts in terms of the outperformers last year. Going into this year, we are more focused on SA Inc. Stocks. One of the stocks we actually like at the moment is Hyprop. It was one of the big underperformers last year. It did about 3.4% last year. If you know Hyprop, it's 100% retail, predominantly South African. The bulk of their portfolio is South African regional and super regional shopping centers. So on face value, a return of 3.4% to an underperformance for retail stock seems fair, given all the macroeconomic tailwinds that we faced last year. But what's worth noting is that operationally, SA retail is actually in pretty good shape. Overall vacancies in the retail sector are around 5%. But more importantly, and something we pay a lot of attention to, is if you look at the occupancy cost ratios for the retailers, they're sitting at about 6.8%. So to try and explain that, the occupancy cost ratio is the rent plus all the utilities and operating costs that a retailer pays to his landlord, that number divided by his turnover. That's sitting at 6.8%, where it previously, in a pre-COVID environment, hovered around 8%. So even though there's been a lot of talk around rising municipal rates and electricity costs, etc., when you look at the ultimate cost for the retailer, his cost of occupation has actually gone down. So for us, that's quite positive. In our view, that's supportive of rental growth to come in the retail sector. And as a result, we're actually quite bullish on SA retail going into 2024. Adding to that, Hyprop currently trades at a 50% discount to NAV. So that, the valuations remain quite supportive of that argument.
We'll get to net asset values in a sec, but it's interesting that you mentioned Hyprop because they were a bit bullish towards the end of last year with that acquisition of Table Bay Mall for 1.6 billion or just over that amount. Were you going to add further comments on other stocks before I interrupted you there?
I'll give you an example of another one we like being Equitas. Equitas has got a logistics portfolio in South Africa and in the UK. They came under a lot of strain because of their UK business. The UK, logistics sector has kind of seen valuation write-downs of 20 to 25% last year, and as a result, Equitas was one of the underperformers. It's actually down about 6% for the year. We think there's good value in Equitas at the moment. They've managed to dispose quite well. And we actually, just looking at our numbers again, we're actually looking for a positive reversions coming through in UK logistics valuations going into 2024. So we think that will be quite supportive. And as a result, Equitas is one of the stocks that we like as well.
Thanks for that, Mohammed. Just on the net asset value perspective, I've been asking various REIT CEOs, and Vukile CEO has been quite vocal about too much attention being paid to net asset values. But what's your thoughts on this? Because pretty much most of the sector is trading at a discount to net asset values. Can we expect that to change a little bit this year going forward?
Correct. Yeah. The sector, I think on average trades at about a 30% discount to net asset value. The cheaper stocks are trading at about 50 odd percent. And I think the most expensive in inverted commas stock is trading at around NAV. So on overall, the sector is trading at a considerable discount to NAV. I think investors typically do tend to focus more on cash flow and income versus NAV. But it's always good to use NAV as a bit of a sense check. And as we learned last year, is that if stocks look unreasonably cheap from an NAV perspective, they tend to get taken out. And we saw two examples of that last year with Industrials REIT, which at the time was trading at about a 40% discount to NAV. And we saw a similar story with Liberty 2 Degrees, which was also trading at about a circa 50% discount to NAV, and that ultimately got taken out. So, agreed. I don't think it's, I don't think it would be fair to assume that the sector is going to trade up to NAV anytime soon. But with that said, a lot of the concerns around NAV, or one of the bigger reasons why property stocks were trading or are trading at these big discounts to NAV, is a view that the NAVs will come under continued pressure. With bond yields easing, with interest rates expected to ease off in the short to medium term, we think that that's less likely to happen, and we should see more stable NAVs being printed in the sector going forward.
It might be unfair to ask, but to conclude, what's your overall expectations for listed property performance-wise for 2024, especially since it's an election year?
Yeah, so I guess that's the big unknown. I guess, if we had to just focus on the numbers, it's quite straightforward. The sector's trading at a distributable earnings yield of 10.5%. It offers a fairly stable or fairly secure dividend yield of around 9%. A big unknown is where's the 10-year bond yield going to settle. We've penciled in 10.8% from the current 11%. So we're expecting a slight re-rating in the bonds. And when we plug that into our models, we end up with a total return expectation of about 14 to 15%. For the year. So that all sounds quite straightforward. Again, the trajectory of that's very difficult to call going into an election year, as you mentioned, with all the uncertainty around that and also geopolitical uncertainty globally. That's quite difficult to call. But on an overall basis, if we're just focusing on the numbers, we think SA property is quite attractive. And there are some tailwinds locally. It's not all bad news on the domestic front, which we think will be further catalysts for growth. So as I mentioned to you, just looking at overall rental levels in the retail sector, load shedding, which the situation is expected to improve this year. I was just reading an article this morning talking about kind of stage 3 being the new stage 6 for this year. And if Eskom is able to meet that, then I think we'll be in a much stronger position this year as compared to last year.
Some positives there. Mohammed Kala, I really appreciate your time today. All the best. That was Mohammed Kala, Executive Director and Portfolio Manager at Sesfikile Capital.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories. The Property Pod.